Hey there, folks. How are you? Welcome back to the channel. Okay, so I'm doing another Q&A question today. This one's about first-time investors. Question is, what are some tips and strategies for first-time investors to employ to weather the current market volatility? What would you recommend to first-time investors to dip their toe in the waters? Okay, going to answer that in a sec. Before that, though, if you like my content, please do the old like and subscribe if you don't mind. That helps me out. And also, I wanted to mention that I've done yet another update to my main course, and we're even changing the name to Personal Finance Mastery. It is even more extensive than my last update and really focuses on teaching you how to run the business of you, maximize your income, maximize your potential, and be as optimal as possible, both in managing your finances, but also planning ahead, tax planning, investing, and so on. It's a perfect, easy to follow, top to bottom course on personal finance. Check it out, link below. Okay, so to answer the question here, if you're a first-time investor, you're likely on the younger side, is my guess. Most people that are probably in their 40s and 50s know a little bit about investing at this point. They might not be doing it super actively. Many are, some aren't. I'm always surprised to find how some people have saved a lot of money, but they're still kind of have it in a savings account because they're a little paralyzed on what to do. But assuming you're on the younger side, ultimately, I don't think you need to worry so much about the market volatility. You just need to focus on investing consistently from an early age and doing it, employing the process, I guess you'd call, of dollar cost averaging. So you invest a specific amount of money every month, and you rain or shine, market up, market down, you invest that same amount of money. So let's say it's $100 a month. You're just going to do that consistently over time. What that is going to do is allow you to buy the market at lows, at highs, all over the place, but essentially average your money into the market so that you don't necessarily need to worry about, hey, am I buying it too high? Am I buying it too low? Well, you always kind of want to buy low, but because you're getting the average of your investment over time. Now, of course, $100 a month, you can't just do that for your whole life. You're going to have to invest more. As you make more money, you want to increase the size of that monthly investment. I hate to put a percentage on what that monthly investment should be of your income because depending on your income, it just might not be enough. I mean, the truth of the matter is the less you make, the harder it is to save. So you do the best you can when you're making less money, and you really try to ramp it up when you're making more money. But I think people's goal is not so much a percentage. It should be about $15,000 a year at least that you're getting to saving as soon as possible. So that would be a little over $1,000 a month. Let's say $1,000 a month. So start at $100 a month, and as soon as you can, work your way up to $1,000 a month, but just keep making that investment consistently over time. Now, in your 20s and 30s and 40s, you can dollar cost average, assuming you're going to be working into your 60s. You don't have to really worry about market volatility. As you get into your late 40s, early 50s, and certainly in your 60s, now you need to switch your mind a little bit into capital preservation mode and not be so stock heavy, and start to think about a balance of investments that will provide a decent return, but also protect some of your capital. Because you don't want to run into a prolonged market downturn, in the early 60s, right when you're about to retire, and all of a sudden you got to put off retirement, for another 5 years or something like that. So just general caution there. Now, last bit about this, what do you invest in? If you're in your early 20s, 30s, and 40s, I think the simplest approach, and you'll hear this all over the internet and probably even from your investment advisors, is likely an index fund that invests in the market in general, which might be represented by the S&P 500. Vanguard offers a total market index fund as well. That's the simplest, set it and forget it. You don't have to learn too much. about investing approach. I like that approach. The market historically has provided about a 10% compound annual growth rate. So, and I think that's reasonable to kind of count on in general going forward. But, the growth rate happens like this, so when you have those down markets, if you have extra money, that's the time to double down. If you have the extra money on the sideline, often people don't. So just follow that consistent investment approach. And then as you get, again, towards your late 40s, 50s, 60s, start to dial in a different asset allocation. Some people will say the amount of bonds you should hold is equal to your age, so you should be changing your asset allocation earlier on. I don't know. I mean, we could debate that, but I think, you take those early working years and you try to get maximum equity growth. I guess that's my opinion. Anyway, hopefully that's helpful. I will see you in the next video. Thanks.